Hi there. So in the previous video we looked at the recognition criteria for a contract, right? How we identify contract with a customer. We spoke about 5 conditions that must be met for us to say that yes, there is a contract with a customer. And then also we made mention of the fact that to recognize revenue under IFRS 15, we need to go through these 5 stages. And the first stage is the identification of contract with customer. Now, so after we have identified the contract with a customer, yes, we have both of us have approved the contract. The contract has a commercial value. The terms of payments have been agreed upon. We know that it is probable that we're going to be receiving the money. We know how much money we're going to be receiving, and we know what we're going to be doing under the contract. That is the first stage. We have identified the contract. The second stage is to identify the performance obligation. Now, in the previous video, I defined performance obligation, but I'm going to repeat it. So performance obligation refers to the activities or goods or services that an entity transfers to a customer under a contract. All right? The activities, goods or services that an entity transfers to a customer under a contract. So we need to identify the performance obligation. What are the things that we are going to be doing under this contract? So for instance, back to my illustration, if you come to me that I should teach you, the question that I'm going to be asking myself is, what really are the things that I'm going to be doing during the 2-month period that you are approaching me to teach you? All right, maybe I have to teach you, I need to give you books, I need to help you in your registration, then possibly I need to go on, yes, maybe let's just stay with that 3. I need to teach you, I need to give you books, and I need to give you or help you when you are registering the exam. So now when I say help you, it doesn't mean financial help, but then technical help in relation to submitting your registration forms online and all those things. So these are the 3 things I'm going to be doing under the contract. That is what we call performance obligation. So when we know there is a contract with a customer, we need to now find out what is the performance obligation. Another example that I could give you is that, let's say Akosia signed a contract with a telecommunication to provide, sign a contract or sign up for a contract with a telecommunication firm. The contract is such that Akosia is going to pay $5,000 every month for 6 months. In return, at the signing of the contract, the telecommunication firm will give Akosia a handset, an Android phone, and also will provide a monthly service for Akosia for the 6 months period that she is going for. So here, when we look at the performance obligation, we are not looking at what the customer is doing, rather we are looking at what the entity is going to do. So from the telecommunications perspective, or from the telecommunication firm's perspective, we know that when the contract is signed, the telecommunication firm will provide a handset or an Android phone to Ajoa. That is the first thing we do. Then second, over the 6 months, we are going to be providing what? Network services for her to be able to use the smartphone, because that is what she has signed up. So when we identify the contract with the customer, the next thing we do is to identify the performance obligation. Now, that second step there is very important because it's going to click up in the 4th step where I said we'll be doing a couple of workings there. Then the third thing is to determine the transaction price. Now, I defined the transaction price in the previous video, but let me define it again. The transaction price is simply how much consideration that the entity received, excluding amounts paid to third parties. That is what we mean by the transaction price. So let me come with my illustration again. You come to me that I should teach you for 2 months and you're going to give me $2,000. Now, I have a policy that anyone that recommends me to somebody, I'm going to give the person $500. So meaning that that commission that I'm going to be paying to the person is going to be different, right? So that money goes to that third party for that commission. So how much money that is actually coming to us as an entity is going to be the 1,500. And because the reason why we are paying that to the person is that you also know that we'll be paying that to the person. So technically, it means that the transaction price, how much money that is actually coming to us, is going to be $1,500. So that is what we mean by identification or determination of the transaction price. So 1, identify the contract with the customer. 5 conditions we spoke about must be met. 2, identify the performance obligation, what we are going to be doing as an entity under this contract. And then 3, you determine the transaction price, how much money we are going to be receiving under this contract, excluding how much that is paid to external or third parties. Then the 4th area, which is going to be an exhaustive one, is where we look at the fact that we say allocate transaction price to performance obligation using the standalone price of each performance obligation. Allocating the transaction price to performance obligation using the transaction price, allocate the transaction price to performance obligation using the standalone prices of each performance obligation. So what does that mean? Let me go back to my illustration right here. So let me soup up my board and go back to my illustration. Remember I said you come to me for me to teach you for 2 months, and under the teaching, the contract is that I'm going to teach you, alright? Then I'm going to provide you with books. Then also I'm going to help you in registration. So this is step 2. We've identified the contract. This is step 2, performance obligation. That what I'm going to be doing under the contract. All right. Then the transaction price, how much I'm going to be charging you TP, transaction price, maybe let's just say $1,500. That is the 3rd step. We've determined the transaction price. So after we have determined the transaction price, what do we do? Right? After we've determined the transaction price, what do we do? That becomes the 4th point, where we allocate the transaction price to each performance obligation. So these are the various activities or services that I'm going to render to you under this contract. So using the standalone price, the standalone prices simply, or the standalone price is simply the price at which a performance obligation could separately be sold for. The price at which a performance obligation could be sold for. So if I'm teaching alone, I could charge the person $1,000. My books given to the person, I could charge the person $700. When I help people to register for their exams, I could assist them with that, and I'll charge them $300. So these are what we refer to as the standalone prices. So once we know the standalone prices, we're going to allocate that. So the total of this is 2,000, right? 2,000. So when we are allocating this, this one is going to be 1,000, okay, over the 2,000 times this particular figure, 15,000. That gives us how much we are going to allocate to teaching. That we will do for books. That is how much we will allocate to book. That we will do for the registration. That is how much we will allocate for the registration. So what does this mean? It simply means proportionately sharing the transaction price to the performance obligation using their standalone prices. So that is also the 4th thing that you need to understand. I'll see you in the next video as we talk about the final stage.